Hello, everyone. Welcome back to the Market Bites podcast. Hope you are all doing well. Do remember to like, share, subscribe, and give us a rating if you're listening on the podcast. I've got the dream team with me today, Josh Gilbert and Neja Mulk. Josh, how are you?
I'm good. I'm jealous that two of the three of the dream team got to meet in Paris not too long ago. But other than that, I'm doing very, very well. How are you, Sam?
Yeah, good. Yeah, we were in Paris last week. Sunny Paris. I mean, it was sunny basically everywhere in Europe by the sounds of it. But yeah, it was good to be with everyone. It was great to see all the different analysts. Josh, you were sorely missed, so hopefully next year we can put it somewhere a little bit closer than a 24-hour flight away for you. But yeah, it was good fun. Neja, it was great to see you. But how are you doing?
I'm doing well, thanks. Yeah, we had a really great time, but um, yeah, it's fun to meet everyone in person at least once per year. And Josh, you were definitely missed, and I hope to see you next year.
Thanks,
Yeah,
guys.
absolutely. Right, now we've got all that niceties out of the way. Let's get on to the podcast. It's still been another interesting 7 days, and it's going to continue to be so. But we're going to focus on one question today. We'll obviously go into that in a little bit of detail, but I want to discuss whether we think the market low is in for US equities. Do we think we've seen the low? And we've got a few different questions to go through. So, Josh, I guess the first one, we've got 6 different questions, and then hopefully people that listen to this will understand it a little bit more. If you're on YouTube, drop a comment, let us know your thoughts as well. But when making a potential decision about whether we've hit a market bottom or not, what sort of key indicators are you looking at? What are you watching to maybe determine that we've seen a low?
Yeah, look, I think when we're talking about market bottoms, I think in this scenario, I think the hardest thing here is that we have the biggest unknown, which is the US president. There are unfortunately no indicators to give us any idea on what he's going to do on any given day. Policies changing from day to day, and that's why we are seeing sort of volatility where it is sort of right now. So this is sort of something, although sort of, market sell-offs, bear markets aren't, mysterious, they aren't unknown. What we are sort of seeing right now in terms of policy decisions is completely out of the ordinary and is sort of unknown. So that's the hardest thing right now. In terms of indicators, look, going back to that volatility, I'd say the VIX is a great gauge. In recent weeks we've moved above sort of 50. I think we maybe even got to did we get as high as 60? I can't remember. But look, I think right now we're sort of around about the sort of the 30 mark. If we move below that 30 mark and close to the 20 in the weeks ahead, I think that's a great sign that volatility is calming, and I think it will give investors a bit of confidence to sort of maybe move capital back into the markets a bit more freely. Of course, I think, going back to the president, I think any further de-escalation from a trade perspective, negotiations, etc., I think that will continue to sort of see sentiment lift up pretty quickly. We're also moving deep into Q1 earnings season, so we're going to listen a lot to guidance. Any better than feared guidance, I think, could be a big win. Look, I'm sure we're going to have someone out there tracking the words tariffs and recessions during those sort of earnings calls. AI will be able to do that for us these days. But I think 2 other key parts I think are really going to be quite key as well. Is going to be a bit of a bottom in commodity prices. We've already seen that in oil for the time being. That's bounced from around about $54 in crude back to above about $61. And we're also seeing some early signs of support in the dollar index as well. So those are going to be 2 pretty key areas that I would watch as well. Of course, obviously, number of technical indicators as well. More your bag of tricks, Sam, but, moving averages, support levels, all those sort of types of things as well are going to be sort of really key inputs. But look, that bottom, it's whether it's in or not, it's, if it is, it hasn't been obvious that it has been in. And I think any decision of an investor to buy will have to be based on a balance of almost probability, right? Because we aren't going to get any certainty in the short term. And how early you buy then depends on that risk profile. And many people listening to this would have taken the opportunity recently to buy amid the volatility. Others would have rode it out. Either way, it doesn't really matter. But the bottom isn't when things feel good. It's often when we're sort of at the peak of that fear and that concern. And that's sort of often when it can be the hardest to sort of buy. So look, we did get a pretty big low, and then we had one of the biggest rallies we've sort of ever really seen on Wall Street. So whether it's in or not is yet to be seen, but we've certainly had a pretty big rebound since then.
Yeah, I think very well said. Very well said. And speaking of Trump, he think he tweeted or posted on Truth Social, whatever it was, that the market had the best ever week last week, and I'd like to remind him it had that because of the situation that you put us in before. But here we are. Here we go.
Win the win for him.
Yeah, Nezha, when we look at sort of the economic conditions, interest rates, and so on, inflation too. Do they influence your view on whether the market may be going up or down or sideways?
Yeah, I mean, definitely those two, inflation and interest rates were under the spotlight for the last 2 years, but now with all of president comments, they are kind of we lost attention on them, but I'm still thinking a lot about them when deciding what to do on the market, because in the beginning of this year, if you still remember, that was only 4 months ago, people were still expecting 6 rate cuts, and some forecasts were calling for federal rate cuts to be as low as 3% by the end of the year. And just in these 4 months, the narrative has completely shifted. And I think that we should think about it as well, because lots of that comes to tariffs, of course, because new tariffs added another layer of uncertainty. And this essentially is important because those tariffs could raise costs and could drive inflation back up. And this is obviously one of the major fears that the Fed currently have. And because of that, they are not in such a rush of cutting rates. But the irony is that inflation data so far is looking decent. But the Fed has made it clear that they are not in any kind of rush, and they won't make any unpredictable fast decision. So that really got me thinking, what does that leave us with? I think that inflation and interest rates are still two of the most important factors on market trajectory. And so far, at least I am remaining cautiously optimistic about those two. I think Fed is doing an incredibly good job. And fundamentals are still supportive for equities, but we see that market is incredibly sensitive right now. Every CPI print, every Fed comment, every trade headline is moving this sentiment. So I am expecting more volatility in following months, but this is not necessarily bad for investors. I think that all of this volatility is creating new opportunities, especially if you are paying attention and not just reacting emotionally. And inflation and interest rate and Fed comments can give you lots of insights where to go, how to move, and how to react in this market.
Yeah, I think a good thing for the Fed at this point, they'll probably be quite confident and they've got that sort of flexibility to sort of be able to react, right? And
Yeah.
also the biggest thing I think for central banks is not sort of moving too quickly. We've sort of seen such a big shift in policy, such a big change day to day. No one wants to sort of really overreact. We obviously saw lots of central banks having those sort of emergency meetings and there was chatter about emergency cuts. We were never really going to get that, were we? But again, it's sort of no one really wants to sort of overreact to a particular situation, but also no one wants to sort of, misstep really. So I think, yeah, again, sort of all of the data points that we're going to get from, as you say, CPI, Fed comments, Fed speakers, rate decisions are all going to be sort of pretty key. And, just having a look at some data today, sort of the volume around sort of CPI data, sort of volume, trading volume had sort of picked up significantly, the highest that we've seen in a year. Obviously, of course, that's because volatility had picked up at the same time. But I think that's something that's going to stay. And I think it comes back to investor sentiment. And I think, Sam, one of the questions we've got to look at as well is like, what role does that investor sentiment and that sort of psychology of market play in sort of trying to identify a potential bottom as well right now?
Yeah, massive, doesn't it? It really does. I mean, even if it's just like, when we talk about crypto being at all-time highs and we discuss things like, in that, when we got that taxi the other day and the taxi driver's starting to talk about it, you think, well, hang on a minute, this is near market top kind of stuff. And then it's the opposite, right? When things are really poor and sentiment is really low and everyone is starting to talk about it being the end of the world, that's probably when it's a good opportunity to get involved and that we are going to see a low. I mean, there's some really good sort of contrarian signals out there. Obviously, you've got the VIX, worth having a look at when that gets to historical highs, and you compare it to, previous crashes or times in the market where there was panic. And if you don't think it's as bad, then maybe that is a good place to potentially look for a low. You've got the AAII survey as well, which can signal capitulation. And then again, you compare that to previous times throughout market history, and if that's a good opportunity to get involved, and then it could well be a potential bottom there as well. And then Josh, you mentioned earlier about moving averages and the like that. There's quite a few good oversold technical tools which can look at RSI, can look at Bollinger Bands as well, that may suggest that the market is sort of primed for a rebound as well. And then the simple support and resistance, I was looking at the S&P 500, it's had an incredible move from that low. However, it's still below a very key, what is right now a key level of resistance. And we did a webinar on Monday where we talked about this in detail. If anyone wants to check it out, I'll put the link in the bio. But that's important for sentiment, just from a technical point of view. But yeah, definitely, I think all these things are worth keeping an eye on, whether it be the news, whether it be sentiment indicators and put call ratios and all of these kind of things, or even just volume as well. With trading volume, can increase with sort of widespread panic, and then that can obviously then lead to a bit of a stabilization as things start to change for the better. So yeah, I'll be keeping an eye on these things. I think when you put it as a piece of the puzzle together with everything else we talked about so far, it is exactly that. It is a piece. It isn't the sole thing to look at, but it's something that I would be keeping a close watch on over the coming days. And over the last week or so, things maybe look a little bit better from this point of view than they did, for example, say bang on last Monday, Black Monday they were calling it, weren't they? Didn't quite go to plan for all the bears for the rest of the week though. And Neja, that brings me on to, I guess, a question about specific stocks, and maybe people saw the recent downturn in equity markets as an opportunity to buy. So are there any specific stocks that have shown signs of recovery that also suggest the low might be in for them?
That's very hard to say, because you already mentioned that how quickly things are changing, and day-to-day changes are very big. So for all of those who want to have more daily updates, don't forget to follow us on social media platforms where you get more daily updates and not just weekly podcast. But if we talk about recoveries, I would say that on one hand, we are seeing a broader sector recoveries, because the tech, for example, is up 11% in just 5 days. And we are also seeing strong rebounds in all other sectors in the past 5 days, not a longer period, if we are looking at SP 500 sector performance. So I would say that this kind of movement could suggest improving sentiment and maybe even a formation of short-term bottom. But when we look at a bit longer time frame, like 1 month sector movement, consumer staples are the only ones in green. And if we want to highlight just a specific company that has been performing well during this market downturn and this big volatility, we could also take a look at some miners. For example, there is Newmont Mining, which is up like 42% year to date, and it is performing very strong no matter the volatility. Looking at shorter time frame, I think it's up 21% just in last 5 trading days. Obviously, surging gold prices are one of the main reasons behind this sector performance. But we are definitely seeing some shift in investors' preference. But I think that we cannot ignore the fact that global investors have just recorded the biggest 2-month pullback in US equity exposure on record. That was according to Bank of America. And I think that this is something that could really tip on where we are going are earnings. Josh already talked about ongoing earnings season, and I think that we will have a much clearer view when earnings are starting to coming in. We already saw Netflix yesterday, and more big tech earnings are coming in following days. So over the past few weeks, we've been mostly trading on fear, politics, and speculation, but now we are finally getting some real numbers. We will see how companies are performing. And even more importantly, what do they think about going forward? I think that all investors will be laser focused on companies' guidance and also how executives talk about forward-looking risks, because we have also seen some banks beating expectations thanks to trading revenues, but they also warned that consumer confidence is not that high. So we have some factors that are not that encouraging, but yeah, we might be in early stages of rebound. No one knows what will happen in following days, if we are getting some crazy tweet again or not. But to really confirm the bottom, I think that we should see the good numbers, also talking about macroeconomics and also companies' reports.
Yeah, I mean, it feels better than it did, last Monday when you're looking at the market. And, we were in Paris, weren't we? Monday, Tuesday, a bit of Wednesday. And, one minute you're looking at things and it's great. The other, it's down again. And it's tough, psychologically for a lot of newer traders and investors. It's tough right now to know exactly what's going on. I saw a tweet someone put out on Sunday. Well, how do you think the market's going to react this week? And as a joke, I just replied, Monday be bullish, Tuesday bearish, Wednesday bullish, Thursday bearish, and like just saying that the market has no idea what it's going to do. Josh, let's talk about historical market cycles. I think it's always good to compare things that we're seeing now to things that have already happened. Obviously, they're not always going to be exactly the same, but there might be some similarities. And I think it's always good to put things in perspective. So what can they tell us at the moment?
Well, I think history tells us that markets look forward, right? And I think investors have been looking at that and have been quite happy to sort of pick up some of these companies at pretty attractive prices that have fallen over recent times. Of course, the biggest risk here is that, as I said earlier, we don't know what is sort of going to come next from Trump, and that ultimately we don't know what's going to sort of affect earnings. I think we're sort of seeing breaking news coming out of the last sort of 24 hours around Nvidia and sort of the view they're going to have to sort of stop selling chips to China, which could be a massive hit on sort of Q1 earnings, right? Or sort of the sort of next earnings sort of coming through. So massive, in that sense. So that's the hardest thing I think for investors is you're almost having to sort of look very, very far ahead and have a big picture. For traders, even, harder right now because we're sort of moving so quickly. I think if we go back to the COVID crash, again, very different scenario to what we've seen today, but we had that bottom came in even as cases were rising. Right. So you sort of, we're at that peak fear, even as cases are rising, everyone's going, okay, this is only going to get worse from here. Things are getting bad. That would, for a lot of people think it would be an opportunity to keep selling. But ultimately markets were looking at the view of the aggressive monetary policy, fiscal support was on the way. And that was a big lesson for a lot of retail investors is to sort of try and look ahead and think what's going to be sort of coming and what does play out. At the other end of this, do we then see more efficient businesses? Do we see these businesses have better global scale, not reliant on sort of one area? Or is it the opposite? Are margins being compressed? Do they not make as much money as they have done in sort of recent years? So those are, I think, the things that we've got to sort of look at. But I think the biggest lesson and the biggest takeaway, particularly from the biggest drawdowns that we've seen in history, is that markets move higher over time. What we're seeing is similar to previous market cycles. We're seeing market drawdowns across, global indices, rising recession fears, volatility, very, very high, intraday swings and pretty high and falling investor sentiment, rate cut expectations climbing quickly, despite inflation still being a concern, which is, as we've sort of already said, a bit of policy uncertainty in there. And that looks familiar to, what we've seen in past market cycles. And if we have a look back at, some of the biggest declines that we've seen in history. So sort of some of the biggest 3-day declines, obviously when we had that S&P 500 sort of route where we had the sort of one of the worst 2 days in history, and then we had one of the worst 3 days, sort of back to back in history. If we look at the 1 year, 3 year, 5 year returns after that on the top 10, they're all positive.
Yeah.
More positive. I think the lowest 1 year return is at least 17%, and that's from the top 10 biggest 3-day sell-offs. So again, it's about looking forward. I think that's what the market can tell us, is to sort of not look short-sighted. Look, it is hard, right? I get it, and we all get it here. Opening that portfolio, seeing the red, it's never nice, and seeing some of the biggest, drops in your portfolio that you're probably likely to witness for many, many years, going back to sort of 2020 and going back to now. My housemate sort of waking up every morning, he's going, "Mate, what is going on?" He goes, "I've lost so much money this week." I said, "You haven't lost money this week, mate, because you haven't closed the position yet." I said, "Come back to me in 3 months and we'll have a conversation then if you've lost money." But that is it, right? It's that sort of straight reaction that you see that red, and it's gut-wrenching, right? But it's about trying to sort of zoom out. And if we look at that sort of, as I say, 1 year to 3 year, 5 year, bigger picture here, we're looking at green. So I think that's the takeaway.
I think that's very well said. And I would also add that in last year or last 2 years, especially value investors were complaining about the lack of opportunities on the market. And maybe now is the time that we should be happy, especially if we have some funds on the side that we can invest now that everything is in reds most of the days, at least. And also talking about market bottoms, when looking back, it's hard to identify, it's easy to identify when markets did bottom, but when you are in that cycle, it is difficult to say if we are here or not, because markets can stay choppy for months as investors are really waiting for this confirmation that the worst is behind us. So talking about that, Sam, what are the risks or some events that could push market lower or confirm that this low is really behind us and that we are going higher right now?
Well, I think number one is going to be, when it comes to events, is literally just going to be what he tweets, what Donald Trump tweets. And I had a conversation with someone probably about 3 weeks ago, maybe a little bit longer, just about whether we think the market is going to go higher or lower from where we are right now. I think it was after DeepSeek had moved the market lower and we'd sort of gone back towards all-time highs, then we'd come off a bit and then we'd moved higher and we're sort of mid-range of that period. And I said, I think my gut feel is we go higher, although it all depends on what he tweets about tariffs. And this person who I was speaking to was like, "I don't think it's got anything to do with that." Well, who's laughing now is what I would say to them. But yeah, Trump, whatever he says, I think is going to move the markets most. Then I guess when you look at, economic data calendar highlights, you chuck in inflation there. If that is to come in higher than expected consistently, then the market's not going to like that. And if anything, that would be a pretty good shock right now. I think it looks, for the most part, that inflation has been cooling and coming down globally. For certainly the central banks that are looking to lower interest rates. Obviously there's other parts of the world where that is different, like Japan, for example. But yeah, I think if we see persistent inflation, that would be a bit of a shock to markets and would help send us lower again. Any geopolitical updates as well, certainly when you chuck in trade wars, that geopolitical risk does rise a little bit as well. So any ongoing developments there, it just takes one comment taken the wrong way for things to go bad. And I think one of the other reasons, other than the headlines, that we are lower from where we started or from the peak is uncertainty. Markets just hate it, and geopolitical tensions don't help with all of that. As Josh mentioned, now we're getting into the meat of the quarter one earnings, so keep a watch on all of that. It's going to be fascinating to see what word is said more, AI or tariffs. I'd like to have a little bet on that. I'm not entirely sure which one will be the winner. Probably just about still AI. But at least all these companies have got an excuse, haven't they, for slightly missing things, and maybe investors will take that as well. But yeah, keep a watch on all of that and the latest economic data and central bank meetings and what the central banks decide to do. And you know, Jerome Powell, I think he's got what we're now April, May. He's got 13 months left of his term. Usually in football terms, this would be when they start thinking about signing him up on a new contract. It doesn't quite work like that for the head of the central bank, the Federal Reserve. So yeah, he's got a few more central bank meetings. Hopefully, no policy mistakes and missteps there, but obviously one to keep a close watch on. And then anything from a technical point of view as well. I mentioned it does technically look like we've had a low, but it also technically doesn't look like we've broken what is currently resistance. So we're in sort of a no man's land at the moment. So you would like to see price technically push above that. If it doesn't and things start to move lower, then that is, you know, a risk that traders and investors need to be aware of. So all in all, it'd be interesting to hear what people think about whether we have found that low or not based on everything we've said. I am on the side that with everything I know right now, I believe that it's more likely than not that we've seen the low. I did a poll yesterday where I asked specifically about the S&P 500 and NASDAQ, about whether the eToro audience believed we had found a low. And just bear with me 1 second. The answers were yes, no, and then ask Trump. So 25% of people said yes, 27% of people said no, 46% said it's all about Trump as well. So yeah, I think that's probably fair, isn't it?
Yeah, look, I to be honest, I do think that bottom did come in. I think that when we had that sort of massive rally off to the back of it, it was a massive rally, wasn't it? It was just after he sort of tweeted that, or he put on social, this is a great time to buy, and then markets rally, which is just ridiculous to think, isn't it? It just goes to show what's happening in 2025. But look, I think it's in, and I think something to really keep an eye on is those, you know, earnings. I think we're going to get some really big moves from earnings because it's going to be the first time we're really hearing from corporates, right? And they're going to be grilled. They're going to be grilled by analysts. There's, you know, earnings guidance is obviously going to be really under the spotlight. They're going to have to be pushed to sort of make comments, and, you know, it's going to take some strong management teams. Any slight misstep, if the market doesn't like what they hear, I really do think that we could get some, you know, outsized moves, especially with the volatility as high as it is. So I think that, you know, if you can, you know, stay pretty good and stand up against what's out there, then I think you'll perform pretty well. And if you disappoint investors, you'll be selling off pretty hard, I'd say.
Yeah, that's true. Even executives will make a huge difference in this situation on what kind of strategy they will develop in this current situation. I just checked how Europe is opening this morning, and we see that Europe is lower today. ASML just reported earnings, and they missed on net booking expectations. So I'm looking forward to dig more into the earnings and what happened, because the stock is trading 7% down. And I think this is the start of this earnings season, and we're going to see more big moves in following weeks.
100%. But we'll keep you all updated with everything that goes on. Josh and Nezha, that brings us to the end of the podcast. As always, thank you very much.
Thanks, guys.
Thanks, guys.